What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is July 9th of 2021. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, I want to spend some time to dive into three critical charts that I think everyone should be watching, focused on the long-term time frame perspectives that we promote here on the channel, that I just recently also shared for CoinDesk Live's recent segment. Unfortunately, it's a bit more time sensitive on there, so I thought here on the channel, why not take that extra time and dive straight into it on TradingView to give you guys all the juicy stuff that I'm watching in the market. So if you guys like this video, consider dropping a like. Let's go ahead and dive straight into the conversation. So the first chart I want to focus on is how this cycle is starting to differ from the expectations of an average Bitcoin cycle, and why this cycle overall is different due to market dynamics within the crypto space. So let's go ahead and take a little bit of a look back at history. For the two previous cycles here, within about a 17-month period, and we're looking at the monthly chart for Bitcoins, this is going all the way back to July 2010 to where we are today. In the past two previous cycles, back here where we bottomed here in January 2015, as well as bottoming out here in November 2011, for the preceding and trailing 17 months, we tended to see that this is when we get the first major market correction, right? The first major pullback of 30% or more. And what's interesting is that during these time periods, you can see that we've not only had generally decaying returns, this is expected with every cycle, as from bottom to top, the length of each cycle is getting longer, right? We should expect here that we get decaying returns, as we saw here, and also probably a decaying correction. In this case, we should be expecting a lower corrective value. What's really interesting is that in the most recent cycle that we've been in through, where we bottomed out here in December 2018, what we ended up actually finding is that within a 6-month period, a 6-month to 7-month period, we saw the same, nearly the same percentage return that we saw back here in the previous cycle, much further away from the decay that we usually expect, and not to mention as well, not just in percentage, but in time. We did this in nearly 1/3 of the time that it took for the low here in January 2015 to get nearly the same percentage return, going all the way here to June of 2016. A massive, near year-and-a-half time frame. The same near price action in about 6 months. Now, it's not only the rally that's significant to focus on. We're going to talk about why this is happening, why we get such an exuberant, fast-paced rally where we went from around $3,100 to $14,000 for Bitcoin. But we also have an anomaly in the corrections. Right? Now, albeit we had COVID in this case, which, again, you can either choose to discount or include. If you want to just consider the correction here from pre-COVID and consider that we were going to continue this kind of price action afterwards, or if you want to consider COVID, I think either one are fair, justifiable ways to analyze it. Either way, they still prove to the point here that we should be expecting, in this case, decaying volatility or decaying corrections, right? So instead of a 76% correction here within a 2-month period for Bitcoin back in April of 2013, we saw a 38% correction here for the first pullback. Things were a lot more slow and consistent over time. The 2017 rally was a beautiful technical and exponential and euphoric setup. But this cycle is not the same because of a major dynamic in the market. And that is, in this case, margin trading, whether it be through derivatives and futures contracts, drying up liquidity on the spot market, or through lending and borrowing platforms where people are taking out credit, in this case, stablecoin liquidity, to go out and buy up more crypto assets, or if they're looking to short the market effectively, they're borrowing crypto assets, selling them immediately, and hoping the price declines to repurchase them, return them back to the platform they borrowed them from, and keep the extra profit that they make from the discounted price. Right? It's the same reason we're seeing exaggerated corrections when we should be seeing declining volatility in corrections. Corrections should, in this maturing market, generally be going more towards 20% pullbacks before we start to see rallies. And we should also be seeing more healthier, slower paced rallies over time. And why are we seeing this? Well, it's because we're having effectively short squeezes on the way up. There were a lot of people who started to mess with derivatives and borrowing crypto or shorting crypto, and they got knocked out of their positions. They had to cover themselves, which means they have to buy back the underlying asset, exaggerating the rallies. And then also the longs in this case are starting to build, excessive long positions. We'll just kind of zoom in here to get a little bit of a better reading. In these peak months, people think, oh, Bitcoin's going to 20K, they flip the tone. Bitcoin's going to 20K, 30K, we're going to the moon. In this case, when in reality, they're taking excessive credit to build more Bitcoin positions, Ethereum positions, etc., and different cryptos. And what happens is, as you go lower and lower in price, you have more and more risk of a liquidation event. Okay? And that's what happened here in March. That's why we had the worst sell-off day for Ethereum and the second worst sell-off day in history for Bitcoin. But you want to know something interesting with these exaggerated rallies and corrections? We've seen it yet again here in this cycle. Right? We've seen it here generally from September 2020 here up towards March of 2021, a 557% rally, again in 6 months, followed by yet another correction of grand proportions. And you can really take it if you want to take the low point within a 2-month bar, right? A 57% correction here in 2 months. Much further and much more brutal than the previous typical 30, 25, 40% corrections that we were used to in 2017. Not every cycle is the same, and the market dynamics have changed dramatically from the highly driven spot market, people trading just with actual fiat currency on Coinbase, Kraken, on Binance, you name it, Bittrex, etc. Right? Instead of trading on the spot market back here, which give us much more healthier rallies and midterm corrections, we're seeing these exaggerated rallies and exaggerated corrections. And the great thing is you can use this to your benefit. You can realize this dynamic in the market and realize that these 50, 60% price declines, potentially 70%, can be great opportunities. Great opportunities of peak fear and capitulation can be great opportunities, in this case, to capture that next rally and to capture these kind of returns. Now, this is just one chart that I want to focus on. I'd like to also take a look at something that we've talked about a good amount on the channel, which is the concept of expanding cycles. Now, everyone out there is going to analyze cycles in different ways. Some people look from top to top in the market, and some people as well look at another means, which is taking a look from bottom to top. Right? As a macro trader, my goal in this case is to buy at peak capitulation, those 80% dips that we've only really gotten 3 times in history. Right? Some would say we're on our way to an 80% dip now. Again, in this case, perhaps it might be true, perhaps it's not. We haven't seen it yet. But when we get those 80% discounts, those are the prime times to build massive positions, historically speaking. Not telling you guys to go out and do anything with your own money. You got to determine that for yourself, right? But you can see here that these are the peak points here after nearly 80% corrections where we can start to enter into positions and pick the general bottom of the market. And from these bottoms to tops, this is how we're measuring our cycle length. This is what to me is a cycle, right? I don't want to be investing in a bear market. I want to be investing from the bottom, peak capitulation point, and sell into peak FOMO, or fear of missing out, as well as euphoria, right? Well, what's interesting is that if we just take a look at the monthly chart, we're taking a look again all the way back here to 2010 to where we are here today. 11 years, nearly 11 years of price history to work with. What's really interesting is that we see that each cycle expands from anywhere from around 11 months to 13 months. We expanded 13 months from the first cycle to the second. We expanded 11 months here. So if we were to follow history, we should expect that we can add an additional, we'll meet in the middle, 12 months here. 47 months is the expected length of the cycle that we're currently through. Now everyone is so confident right now because the market has gone a lot more quiet. You can definitely see across the board, whether it's here on this channel or other channels, right? If you're here right now, I want to make it very clear, you're a select few viewers who are sticking around, who weren't just watching things when everything's all hyped up and excited and everything's at a market top. Right? Everything is a lot more quiet now, right? But I'm going to let you in on something that a lot of people ignored or didn't see. In the sense of the expanding cycles here, we are far from the expected 47 months. November of 2022 is when we should expect the top, no matter what the price range may be. You might think it's 200K, you might think it's 100K, heck, you might think it's a bear market, you might be convinced that it's a bear market already. But to be completely blunt, guys, no matter if you're looking at 27 months, 28 months, whatever, we are far beyond lower in the previous cycle by 8 to 7 months. This is the first time in history we would have a shorter cycle than the previous. And not to mention, it's not far off from the second cycle for Bitcoin. Is this really a convincing market top, or is it that we got over exaggerated, just like we did here? Like, for example, and this is just a way to kind of view it here. And you can see this within data science models like the stock to flow. There's a variety of other ways that this kind of demonstrates this, right? But imagine here a more healthy median line of an uptrend, right? Similar to 2017. What you can see here is that as we break away from this kind of more healthier trend of revisiting the highs and rallying up higher, you can even have something more optimistic, right? Whatever. But overall, you can see that when we break away, we come back down. And it took us nearly a year here, right? Excuse me, actually, it was more than a year. My apologies, right? Went past June of 2020, a full year, nearly a year and a half of stagnation before we actually kicked off the next rally. And again, over exuberance, the shorts get squeezed in this case, prices start climbing up, and then people start taking levered longs here. The same gamblers who are trying to short the market take what little capital they have left and they're starting to long the market with excess credit to try to make up for their losses or flip their tone. And they might be up a lot in the interim, but then they get liquidated and they lose it all. It happens time and time again. And with the increased amount of people borrowing credit in the market, the access in this case, as well as derivatives platforms, these distortions, these exaggerated rallies and corrections are going to continue to happen. So again, we can see how this cycle differs a lot. And if anything, it's very similar here to the mid-cycle correction we saw in 2013 during the spring summer. Again, take with this as you will, guys. But the last chart I want to show you, which we talked about a couple of videos ago, is the long-term time frame. And I just want to ask you guys this because, look, if you guys are into day trading and stuff, there's really, honestly, I'm not going to speak negative about it. If you want to go out and day trade, you can go out and try that. Teach their own, right? And you are your own determiner of your own destiny. I will say to you all, the reason, though, why I don't promote day trading is because it's just not generally successful for everyday people. You have a very high chance of losing money, especially if you mess with leverage. And outside of that as well, even if you can make money, if you're part of that percentage of 10-20% of people, you can probably make money trading crypto on a day-to-day basis. Even if you are part of that, you likely will not after taxes, after just considering your gains in this case versus what you would have made long-term investing and averaging into the market and trading the broader cycles over a year-plus time frame, you still probably won't outperform those long-term holders. That's why I hold that position. Now, to the actual chart here, right? To the actual substance. What's your time frame for investing? A year? 2 to 3 years? A decade? The people who make significant returns in investing, or albeit trading on a swing trading time frame, the investors who really make the big bucks, and they also don't lose their hair at the same time, are those who make multi-year, decade-long bets, or even those who just generally focus on a 1 to 2 year time frame and then reallocate to another market. I don't know what your time frame is, but I have to say this chart here, as simplistic as it is, this is the 12-month chart for Bitcoin. So each of these candles represent a year's worth of price action going back from 2010, that same chart, to where we are now. I can't tell you all of an asset, either an index in this case, the S&P 500, gold, one of the competing commodities that's usually compared against Bitcoin. I cannot tell you all of an asset class that over a decade's time frame has the likelihood to outperform every other asset class and has already done so over the last decade and continues to do so on an average annualized return other than Bitcoin. The only other asset I can recommend is Ethereum, other broad classes of digital assets in the crypto space, because nothing is going to outpace crypto. There just simply isn't anything on the playing field right now that is a broad established market or is an emerging market that is going to win out against crypto because of the sheer scale of market, or market scale in this case. Bitcoin right now is roughly a little bit under $1 trillion asset. The S&P 500 is an index along with the broader equity market has over 100, probably 110, 120 trillion dollars by now of global valuation. The gold market, 12, 13 trillion dollars. What asset has a likelihood of doubling in the next year? And the point I want to make to this, similar to what we brought up here in regards to the kind of corrections here, is that really, at the end of the day, as much as we're holding to our conviction that we're entering into a mid-cycle correction, not a full bear market, the real question remains, does it really matter? Like, I'll be honest, like, I understand very clearly. Some of you out there would say, yes, Nick, because, after, the 55% correction we've seen, even if you pick the existing bottom right now, and it continues to go down to 60, 70, 80, 90%, that's really, like, those single, there's basically single double-digit percentage declines. Yeah, they can add up a lot, and they can lead to a much cheaper price, sure. But are you really going to try to risk trying to pick the absolute bottom? Because historically speaking, most people don't know how to do that, and outside of that as well, studies have shown that the best way to trade the market in this case, plain and simple, is to do one of either two things. Either to just plainly average in over time, or B, average in, especially on an asset like Bitcoin, in prime spots with the same original allocated capital at price points where we know historically it's favorable to average. Buying into fear. Anywhere from 30, 40, 50, 60% or more declines. And even if it takes a year for us to get back to where let's say that things kind of decline or go sideways, it takes a year to actually start turning a profit, it will outpace any of the other asset classes. Where else do you have to go? That's the mindset that I hold. And I'm not asking that to you guys or being sarcastic or snarky. It's the mindset that I'm constantly asking myself. I'm a macro trader. I'm not married to crypto. Sure, I have a cryptocurrency channel, but this channel isn't just about crypto. We'll cover equities. We'll cover gold if there's a better opportunity there. Because when you come to DataDash, I want you guys to know that the opportunity is what I really care about. Right? I want to be able to grow my capital at the end of the day. Now, it's not really about money. I mean, I don't really know what to do with money at the end of the day. I'm not very materialistic, right? Very simple. But for me, it's a game. As a macro trader, I want to make sure my capital is allocated in the most smart way possible. You have to protect yourself in this kind of environment. So, that all being realized, guys, that's it for today's video. I've rambled on enough. I hope this chart can continue to be ingrained in your guys' head, because whether you're looking at the average annual return, whether you're looking at the decade-long time frame, whatever it is, even just over the next course of the couple months, I can't tell you guys of an asset class I'd rather be exposed to than crypto. So, anyways, enough rambling. If you listened to me long enough to get to this point, consider dropping a like, leaving a comment on your thoughts, whether you agree or disagree. I'd love to hear from you guys. And if you haven't already, consider subscribing and hitting the bell icon. And you can always support me by checking out the dashboard down below in the description. Thanks so much, everyone. Have a wonderful rest of your day. I'll see you all in the next video. Take care, everyone.